So this is tax preparation strategies for childcare businesses. Let's go to our disclaimer. Before we begin, please keep in mind that this presentation is for educational purposes and not to be taken as legal or tax advice. The information contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information is not intended to create, and receipt does not constitute an attorney-client or any other advisory relationship. Reproduction of this information and recording of this content, including the use of AI, are expressly prohibited. Only non-commercial uses of this work are permitted. So today, we will be covering several important tax topics to help you run your childcare business smoothly year-round and not just during tax season. First, we'll discuss why you should care about your taxes throughout the year, not just April 15th. Next, we'll explain what a Schedule C is and how to use it to report your childcare business's income and expenses. Then we'll go over steps that you should take now to get organized and prepare for tax filing next year. And then we're also going to address what we call tricky expenses. Those expenses can be confusing and they're hard to calculate sometimes. And so understanding what is allowable and not allowable is really important. We'll also have a brief mention of a way you can lower 2025 taxes, even though we're in February of 2026. Our goal today is to provide you with tax knowledge to optimize your filing and minimize headaches when tax season rolls around again. So why care about your taxes? Well, there are several reasons to really make sure that your taxes are accurate. And the key word is accurate. You'll retain more profit. Now, while it is the responsibility of every business to pay their fair share of taxes, proper tax preparation can be a vehicle for recapturing your hard-earned profit and keep more money in your pocket. Another reason is risk mitigation. Education is key when it comes to understanding allowable expenses and properly preparing your taxes. The more that you're aware of the tax rules as they apply to your childcare business, the less likely you are to trigger an audit. And audits are very time-consuming. They can cause distress, and at the end of the process, can prove to be very costly, as an audit will most likely result in you owing more money in taxes that you may not be prepared to pay. Third reason is understanding your business health. Reviewing your taxes is a fantastic way to evaluate the health of your business. Having an accurate account of profit really allows you to understand the financial position your business is in and can help you plan for strategic changes into the future. And a fourth reason is having more confidence in your business. Remember, knowledge is key. Having confidence in knowing that you have properly claimed deductions and have met your tax obligation removes the factor of the unknown. That removes any reason for intimidation or worry when it comes to your taxes because you understand that whatever came in is being taxed appropriately, and anything that came out is reducing that tax liability. We'll talk more about that here in a minute. Now, through our years of hands-on experience supporting childcare providers with tax-related challenges, we've recognized the need to identify key areas where businesses could improve their tax filing practice. So to ensure our guidance would be truly valuable, we conducted a comprehensive analysis. We found that over 80% of home-based childcare providers did not even claim the business use of home on their Schedule C, line 30. Now, as a home-based provider, you can deduct expenses shared between business and personal use of your home, which is a significantly missed opportunity for tax savings. We'll talk more about this in a second, or in a little bit. We also discovered cases where providers reported no expenses at all on their tax returns. And this is very concerning since every childcare operation inherently incurs some sort of deductible expenses. Schedule C offers numerous expense categories, and understanding these can help reduce your tax liability while preserving more profit for your business. Some providers claimed inappropriate business expenses, significantly increasing their risk of audit. Now, It's important to remember that deductible expenses must be both ordinary and necessary. That's key. If you're taking notes, expenses must be ordinary and necessary for your childcare business. The IRS has specific expectations for what constitutes valid expenses in the childcare industry, and deviations from these norms can trigger additional scrutiny. It's really important to maintain clear documentation and ensure each expense directly relates to your childcare operations. Lastly, common deductions were frequently miscategorized or miscalculated, which potentially triggers audit flags for the IRS. For example, many providers mistakenly listed children's meals under the Schedule C business meals deduction line, which is actually intended for your own meals when you travel to some place for business, right? Even when the expense itself is legitimate, improper categorization, meaning putting it on the wrong line in your Schedule C, can lead to unwanted IRS attention. All of these findings underscore the importance of understanding proper tax preparation practices specific to your industry. Accurate documentation and proper categorization of expenses can help you maximize legitimate deductions while avoiding unnecessary audit risks. So if you were to get anything from our research, have good documentation and properly categorize your expenses. And those will lead to lower risk of audit, because that's really what we're going for here. In the next slide, I'm going to talk about the Schedule C. But if there's anyone here on this call that wants to know more about just how taxes work in general, I want you to put a thumbs up in the chat or something, or raise your hand, and I can very quickly just explain how the tax system works. If everyone here knows how it works, I won't go over it. Okay. Okay, so I do see one hand. Oh, see one hand in the chat. Okay, I see a couple hands. Okay, all right. No problem. That's awesome. No problem here. So very quickly, taxes work like this. You, as a child care provider, you are providing a service. If you want to look in the bottom left-hand corner of my screen here, let me make sure I'm showing up. Sorry, I am looking for my finger. There we go. So, you provide a service, and for that service, you are paid money. Okay. And over here, we have your home, right? So your bank account. So I'm just going to put B for bank account. Okay. Here's my home bank account. And so when a parent pays you for providing a service of childcare, you typically it'll go to you. But before it goes to you, that money is taxed by the federal U.S. government, because you have a business here in the U.S., and by the state, right? And so typically what happens is before it goes to you directly, these taxes are taken out, and you as the business owner are responsible for taking those taxes out and setting them aside. And then what's left goes to you. So you get to keep some percentage, right, of that cash that was paid to you. Now, here's the thing. The U.S. will keep, or if you're self-employed here tonight, the U.S. will charge, or that work that you have, your self-employed work, will incur if you are a sole proprietor or if you are a single member LLC, this kind of work, that kind of registration, when you file your taxes, that incurs a 15% self-employment tax right off the bat, okay, no matter what. Now, that's 15% of your taxable revenue or taxable income of the business. After that, after all the expenses are calculated, to include that 15%, and really after those taxes are taken out, you then are taxed income tax. Okay. So, and this is where our tax bracket system comes in. All right. Our gradual tax brackets, right? That's where that comes from. So in essence, if you look at this, you're taxed 15% here, and then whatever your, W-2 plus your any other business income that you have, those are combined to determine your income tax bracket. So then you're taxed the second time. Uh, we may have time at the end to go over ways to make this a little more efficient. But for now, this, in a nutshell, is how our tax system works here in the US. Okay. You can put a thumbs up in the chat if that was helpful for you to really break down how it helps. How our system works. Awesome. So thank you. Now, let's look at the Schedule C. While there are various tax forms you'll encounter as a business owner, the Schedule C is a crucial document for reporting business income and expenses. Even if you work with a tax professional, understanding these basics will help you make informed decisions for your business. The Schedule C is used to report income from sole proprietorships as part of your personal 1040 tax return. For single member LLCs that haven't elected to be taxed as corporations, they also use this form. However, if your LLC has chosen to file as an S or C Corp, your business income won't be reported on your personal return, which is a 1040. It's reported elsewhere. An important note, if you operate multiple unrelated businesses, you'll need to file separate Schedule C forms for each venture. For example, if you run a craft business on Etsy and you run your childcare business in your home and you are driving for a rideshare service like Lyft or Uber, all three would require their own Schedule C forms. The basic structure of the Schedule C follows a straightforward logic. First, in this top section here, this is all administrative data. Okay. In the next part 1 is the income. So here in the pink, right, this area, this is all income. And that's anything that came into your business. So if someone paid you cash, if someone paid you via Venmo, if someone paid you via credit card or ACH deposit, all of that would go here. And then part 2, this green part 2, it's not green on the form. It's all white on the form, but it's separated like this for you tonight. Part 2 are all of your expenses. So that's anything that you use to run your business, any expense that's there. Okay, so that's what ends up happening is then you take the total of both of those lines, and then once you total that, that gives you your net profit or your loss, right? So net profit or loss, that's line 31 on Schedule C. That tells you how much the government will, how much you will pay taxes on. That is your taxable income for this business. Okay? And honestly, this provides you a clear picture of your business's financial performance for that tax year. Now, understanding how to properly fill this out and categorize what it is that you are reporting for income and expenses on your Schedule C is essential for accurate tax filing. And here's one thing I do want to mention. Accuracy is key. Some tax preparers and even some childcare providers tend to measure success in how big of a tax return they can have. Well, I'm here to tell you tonight that accuracy is actually a higher measure of success. I would much rather you pay 0 in taxes and receive 0 than you get a big return or have to owe a whole lot that you don't need to. And we'll go through why here in just a second. Now, let's switch gears and discuss how you can proactively prepare for tax season to avoid headaches down the road. If you have a phone, I recommend you pull it out now, it's not rude, and scan this QR code. Or copy down the link that Aaron is going to put in the chat for you. This is a valuable resource that highlights the following things. Record-keeping best practices to implement now, such as tracking income, expenses, mileage. It'll talk about understanding the Schedule C, just like I just described, and where to capture income and different types of business expenses. It talks about how the business use of home deduction works, including calculating and documenting the time space percentage. It'll also help you with maximizing write-offs with eligible deductions for supplies, for meals, utilities, repairs, insurance, improvements, and large purchases. It'll also help with tracking and claiming automobile mileage for business travel, depreciating assets like equipment and furnishings over time that are eligible for depreciation, choosing the right business structure, such as an LLC versus a sole proprietorship, and even proactive tax planning steps to take now to maximize next year's tax return. This workbook also includes checklists, guides, and visual examples that walk through every step to support home-based childcare providers in preparing for tax season by providing actionable steps that you can take to implement and make tax time easier. When it comes to understanding your taxes, you'll find that it's all about what you made and what you spent. Just like in what I showed you earlier with that rudimentary drawing that I shared with you, it really is just that simple. What you made versus what you spent will determine your taxable income. So the first part of your taxes is simply about how much money came into your business during the year. Side note for the parking lot, if you run a family childcare business, if you run a center, if you run any kind of business, make sure you have a separate bank account, ideally a business bank account. And a side note to the side note, if you do open up a business bank account, consider opening a credit card with that bank account. So that way, not just a debit card, but also a credit card to help build your business credit as well. And another really nice thing to do, best practice, is use that credit card for anything that you have that is a regular expense that's simple to pay off. So that way you can build that credit and not run up a high bill and never have to pay interest unless you forget to pay the bill. This can be really helpful for several reasons. It'll help with accounting and will help you keep all of the expenses and all the income in one place. That way you're never commingling your expenses or your income, because that can lead to a pretty significant cost if someone has to try and figure out what's what and if you're not the one doing it. If you already use an accounting system, this step may be easy. If not, that's okay. You can use the revenue worksheet we provide in that workbook that I shared with you and add everything up. The first step is to gather your records. And most of the time, you have three main ways that money comes in. Tax forms, these 1099 forms that come in from the CACFP or the food program, subsidy payments, or any equality rating payments you might get. These forms will show how much they paid you during the year. Payments through apps or banks, Venmo, Zelle, Cash App. These apps typically will provide you with they'll provide you with some sort of a record. If they don't give you something called a 1099-K, which you may have received in previous years, they may not send you one this year in 2026 because the threshold for that requirement has increased to $20,000 in gross payments in 2025 and more than 600 transactions. So although those thresholds could change, it's important for you to pull that form or generate that report from those apps. Okay. So regardless, all forms of money that you received for childcare counts as income and must be included in your total revenue for the year. Now, the last way to show this would be your own records. This could be in any receipts that you gave to parents, showing that you have an income from them, any weekly or monthly payment logs, end of year summaries that you create yourself, or even bank statements. Okay. This is important because sometimes, as businesses have cycles, it's not always positive cash flow, right? So sometimes as business owners, we have to make an owner's contribution, meaning we are putting money, reinvesting money into the business to make payroll or to make certain expenses or whatever the case is. And so we have to be able to show that that owner's contribution or reinvestment of your own funds is not income, right? And how do you show that? Well, the burden of proof is on you. So it'll be important for you if you do make one of those owner's contributions to show the bank statement of your personal account and show the transfer from your personal to this exterior account or this business account so that you have a paper trail showing that you made that owner's contribution and that it was you and not some other source of income. So now that you have your business income, you'll need to collect your expenses. This will be what you spent money on for your business in 2025. Make sure you have records of all of your costs, ideally receipts showing payment for expenses. But you can also, in most cases, use canceled checks, invoices, or credit card and bank records. Now, it's critical that any proof of an expense show that you paid the expense. So there's four things that each expense you need to have documentation for, okay? So one is that you paid the expense. Two is how much you paid, so the amount. Three, the date you paid it. Four, a description of the item purchased or service received. Okay, I'll say again. You paid the expense, showing it came from your account or your credit card or however you paid it. If it's you or the business, so whether you paid it or the business paid it, you have to show that that transaction came from the business. How much, so the amount, the date you paid it, and the description of the item. Now, another side note for your parking lot, if you bought anything from Marketplace, like cots or toys, or a monitor or a computer, if you bought something from Marketplace, Facebook Marketplace or Craigslist, take a screenshot of the item so that it shows proof of how much you paid, right? And even the description of the item, right? Then you'll also, and even the service, right? So sometimes people post on Craigslist lawn care services or what have you, right? So you can get a screenshot of that. Then, if you paid in cash or Zelle, you'll want to show the amount that was transferred and then withdrawn, right? If it's cash, or in Zelle, take a screenshot of that transfer going from you to that person who rendered the service or sold you the item, right? And this can serve as a receipt or some sort of documentation showing that this was an expense for your business. Also, make sure that you have the date on there and obviously that you paid it. Another thing that's important to do is look at your mileage, right? So we'll talk more about what happens with like well, I can say that right now. So driving to and from the grocery store or picking up children or driving to a conference, right? For your business. These are deductions or really trips that you can log mileage for and use as a deduction. Creating a mileage log by using something like Google Sheets or Excel, Microsoft Excel, you can do that. In the resource, there is a Google Sheets link that gives you a simple log template that you can use to fill out in your vehicle, just so that you can show usage of your vehicle. We'll get into that more in just a minute. Now, to collect your expenses, you want to start by gathering all the records that show you paid for your business during the year. Go month by month, review your credit card bills, your payment apps like Venmo or Zelle, your bank statements, and checks. And once you have everything, enter your totals into the digital expense worksheet that's included in the guide that we provided you. And that is organized using the Schedule C categories that are most relevant to home-based childcare businesses. Expenses that are only for your business, such as repairing a bathroom used only by children, buying rugs or toys for the play area, or purchasing playground equipment can be fully included, while shared home costs like utilities and insurance are handled separately under business use of home. Certain insurance, right? So homeowners insurance would be shared expense. But if you have business liability insurance, I'll mention that later in the presentation, that is 100% deductible, right? Because it's only for the business. If you didn't have a business, you wouldn't have it. So be sure you keep proof of payment through tax season and for at least 4 years afterward, whether that's as a paper copy or digital photos saved on your phone, or both, physical copy too. Now let's go over a few categories that are often considered to be tricky topics. We have vehicles, food, your home, and grant funding. We'll go through each of those in depth right now. So let's start with transportation. Now, as with all deductions, there are some very specific rules and guidelines that you'll want to follow. Here are all the elements that you need to make sure your transportation is deductible. First, it must be in the regular course of doing your business and relate directly to childcare, like picking up kids, or be business related, such as going to Costco to get food. You always need to keep personal and business travel separate. Okay, so that's number one. When it comes to business trips, the primary rule is that the trip can be for both personal and business purposes, but it is only deductible if the primary purpose of the trip was for business. For example, if you go to Costco to purchase a long list of supplies for your childcare center or your family childcare home and pick up a personal item like a jar of pickles, the trip would still be deductible since supplying your business was the main reason for going. Okay. So, side note for the parking lot, if you do choose to do this, you'll want to make the purchase for your business on your business credit card or debit card that I mentioned earlier. And that jar of pickles or whatever it is that you're buying that's for the house, personal, use your own credit card or your own debit card for that you use personally. Okay. What this will do is it'll help keep the receipts separate and it'll prevent you from having to go back through a receipt and try and find that one line that was personal and scratch it from the receipt. And then you have to adjust all the numbers that are in that receipt. No need to do that, right? If you do this one thing, it can significantly save you time, effort, headaches, and increase accuracy over time. Okay. So like I said, two forms of payment if you're going to mix business and personal purchases on these trips to the store. Now, on the flip side, if you went to the grocery store like Costco for your own groceries and just happened to pick up an item needed for your childcare business, that trip would not be deductible since your personal errands were the primary driver. Again, the purpose is to find out what the primary reason for that trip is to make it a deductible trip or not, right? Find out, was the trip necessary in the first place for the business? If the main purpose was for business, it can be a deductible trip, even if some personal items were purchased along the way. But if the priority was personal with just an incidental business purchase, then it would not qualify as a business expense. Now, here's how to deduct costs for your vehicle. You have two forms, two actual ways to deduct your business expenses, your vehicle expenses. The actual expense method or the standard mileage expense method. And we'll go through each of these now. The actual expense method captures all costs associated with your vehicle, but requires extensive documentation, including keeping every receipt and logging mileage for both personal and business use. So the pros of this method are that it may result in a higher deduction, especially if your vehicle is used extensively for work. I'm talking, like the fuel costs, the cost to maintain it. So like oil, changing tires, changing the alternator, lights, whatever it is, right? Now, I wouldn't consider car washing. I don't know. I don't think so. That might be a toss up. I'm not sure because if you have kids in the car and it's really dirty because of the kids in the car, then maybe you have a business use case. But again, that one's probably questionable. Either way, the con is that it may take a significant amount of time to collect and retain all the receipts and the mileage logs. Now, while the actual expense method can provide a larger write-off, it also demands careful record keeping to track both business and personal use, as well as proof of payment for all vehicle costs. So, this is important because there's probably also um, I would say like a time space calculation for this use as well. Now I haven't um, if you are looking to expense those other anything outside of mileage, be sure to consult a tax professional. Okay. Now, there's a lot of discussion about changes in 20 to the 2025 tax law around auto loan interest. This is a little side note. If um, if those changes, typically they're for personal loans, and it depends on where the vehicle was made and when it was purchased. So and if it was new or used. So there are a lot of other stipulations. Um, Please consult a tax professional about deducting auto loan interest. So a little side note there. Now let's talk about mileage. The IRS gives you a standard mileage rate, which can simplify the deduction tracking, but still requires a detailed log of business miles driven. The pros of the standard mileage rate are the ease of calculation and fewer records to keep, as you only need to track business miles and not personal miles. However, the cons are that the deduction is actually limited to the fixed rate set by the IRS, and your records may get greater scrutiny. Regardless of whether you use actual expenses or standard mileage, you'll still need a log noting the date, the distance traveled, the location, and purpose of each trip. So I'm going to run through that one more time. You need to know the date, the distance traveled in miles, the location, and purpose of each trip. It's important that you use miles and not meters because all of the IRS calculations are based on miles. Okay. While standard mileage can reduce the documentation burden, you must still carefully track that mileage in a log along with trip details to justify the deduction. Um, there are so here's another side note for this one. There are apps that you can download that will track your mileage automatically. So on in these apps, there's apps like Everlance. I think QuickBooks Online even has one if you're using QuickBooks. There are others out there. Just look for mileage tracking apps in the App Store or Google Play Store. And a lot of times, what it'll do is allow you to swipe left for business and right for personal, or vice versa, right? And so that way. If you can make a habit of this at the end of each day or at the end of each week, just go through and swipe and put in your notes. This was for getting food for the child care home or the center, or this was for going out and picking up kids and dropping them off, right? Or so at least that way, if you have the app, it can create a very nice and neat report at the end of the year, probably by month, by quarter, by date if you want, chronologically, and can even total those miles for you as well. So that could be very, very helpful when it comes to tax time. Just a little side note to help you save time throughout the year. So let's talk about food. The basics for food and meal deductions are that food is deductible with two exceptions. The big question is, how do you do it? Children in your care are fully deductible, and you can report the costs in multiple ways. For staff, only 50% is deductible. For your own children, those costs are not deductible. Okay, so this is important because if you have your own kids, let's say you have 6 kids total, 2 of them are yours, you can only deduct the expenses for 4 of those kids' food because 2 are your own. Now, one thing here as well, something to think about. If you have employees, if you have staff, only 50% of that are deductible. However, there's another way to make them fully deductible if you can make it an employee benefit that they are paid, that they're paid in food actually. So we'll talk about that here in a second. So there are two methods you can use to deduct for a family child care home. If you're a center, you have to use actual expenses. But if you're a family child care home, you can use actual expenses or the standard meal rate, which is kind of similar to like the IRS mileage rate. It's a standard rate that you can use to multiply how much you would actually get deducted. So let's talk about the actual expenses first. So you can deduct as a business expense 100% of the actual cost of food consumed by your daycare recipients, and generally only 50% of the cost of food consumed by employees. However, you can deduct 100% of that cost consumed by the employees if it can be excluded from their wages as something called a de minimis fringe benefit. De minimis fringe benefit. This is how if you have like a helper, right, you can feed them and then it can be considered 100% deductible, but it has to be under the de minimis fringe benefit. Okay. So you can give employees this benefit um, and and it can be excludable from the employee's taxable income. So to simplify record keeping requirements, there's an optional standard meal and snack rate that family daycare providers may use in computing the deductible costs of food provided to eligible children in childcare in lieu of actual costs. Now, you still have to keep track of the meal types and the numbers by multiplying by a set amount. We just put in the chat the link to those rates. Now, if you look on there, it should show uh, the rates for Alaska, the rates for some other like outlying states, and then the rest of the continental US, the rest of the states. So use those rates, okay? And those are based on tier one, okay? They're based on the IRS uses like the table one or tier one rates. Now, the pros of this are they're easier record keeping. You can still deduct non-reimbursed meals and snacks. The con is that you still need to keep the name of each eligible child, when you fed them, and the hours of attendance, and the number and types of meals you serve. So four things you have to keep track of, which is very similar to if you're on the food program to using the food program. The food program requires the same thing: the names of each child, the dates that they were fed, when they attended, right? And the number of meals that you served. So and types. So it's if it's a breakfast, a lunch, a dinner, or a snack, right? Now, the CACFP reimbursement rates can be used by home-based childcare providers to simplify the calculation of food costs, regardless of whether they're participating in the program or not. So these reimbursement rates are the ones that are used. Now, the provider may use a standard meal and snack rate for a maximum of one breakfast, one lunch, one dinner, and 3 snacks per eligible child per day. This is different from the food program reimbursement allowances, which are typically 2 meals and a snack or 2 snacks and a meal. Okay, so it is a little different from the food program. Now, the next tricky topic here is the home. Now, to figure out how much of your expenses are considered business expenses and what percentage of those expenses can be deducted on your federal income taxes, family childcare providers will use the time-space calculation in times. This time-space calculation will help you classify your space as either regular use or exclusive use. So let's take a look at the definitions for both. Regular use areas are used all day, both day and night, and they may have other uses during non-business hours. Okay, so a great example would be your kitchen. If you use the kitchen to prepare food for kids, but you also use your kitchen to prepare food for your family in the evening, that's a regular use space. Okay, exclusive use areas are only used for the childcare program and nothing else. Okay, so if you have a dedicated space for storage for childcare things, or maybe you have a bathroom that's only for children in the childcare during the childcare day, then that would count as exclusive use. We're going to go through how to calculate this in depth here in a minute. Now, home costs can be fully or partially deductible depending on the nature of the expense. Remember that costs for exclusive use areas or direct business costs are likely to be 100% deductible. Okay. So, for example, if you're replacing tile in the basement that's only used for childcare, um, that would be fully deductible. Or having liability insurance, like business insurance, that's fully deductible. Okay. Expenses for regular use spaces or common improvements are only partially deductible based on the business use percentage. An example would be replacing all of the home windows, or repaving the driveway, or having homeowners insurance since those impact the entire property. Okay. In regularly used areas, you need to use the time-space calculation to determine how much can be deducted. We're going to go through that here right now. But the key is identifying whether a cost directly supports the business, benefits shared spaces, or is a general home improvement to determine if it is fully, partially, or non-deductible. Okay, Aaron is going to put the time space link in the chat now. And here's an example that you can use to attempt to calculate this on your own. Okay, so this business, let's imagine that this is a family childcare home. It has 1,500 square foot home. There's 500 square feet that are exclusively used for childcare. Another 700 square feet are regular use. This provider is open 10 hours a day and spends 1 hour before and after prep for cleanup, and one hour before services and 1 hour after services for prep and cleanup. And she's also closed 2 weeks out of the year for vacation. Remember, there's 52 weeks in a year, but 2 of those weeks she's not open because she has vacation time. Now let's walk through this example step by step. If you haven't clicked on it already, go ahead and click on it and you can take a look. So step one, determine the square footage of the regular use space. So in this case, we already know that the total home is 1,500 square feet. If you want, you can pull out your phone and just type these in, right? So 700 square feet are used regularly. The length times width is square footage, right? Taking it all the way back to, third grade when we talked about length times width, right? So to find the square footage for oddly shaped spaces, you want to use the length times width, and then you'll want to break it up into smaller rectangular blocks if it's like an irregular shaped room, like a closet or something. So that way, and then add those square footages together so that you can figure out that full the square footage of that location. Step two, divide the square footage of regularly used childcare space by the square footage of the home to determine the percentage. So in our case here, 700 square feet is regular use, divided by 1,500 total square feet of the home, we get 0.466 or 46.6%. You can write that down there. Now, a note, square footage for outdoor areas cannot be included in the time-space calculation. However, external spaces that are physically attached to the home that are regularly used for childcare, like a deck, can be included in your space calculation. So the next step is to determine the amount of time the home was used for childcare during the year. Remember, this is for the whole year. So to do this, we calculate how many hours the childcare space is open per week, including time spent preparing and cleaning up when the children are not present. In this case, we're open 10 hours per day, plus 1 hour of prep before and 1 hour of cleanup after, for a total of 12 hours used per day. We're open 5 days a week in this example. So 12 times 5 days per week times 50 weeks that we're open equals 3,000 hours. Okay? Now, the next step is divide the hours the home was used for care by 8,760. You can write that number down because that is the total hours in a year. All right. Unless it's a leap year, then you add, an extra day, right? But 3,000 hours used for care divided by 8,760 hours, equals 0.342 or 34.2%. Now, to get the time space percentage, we multiply those two percentages. So multiply the time and space percentages. We do this by taking 46.6% times 34.2%, and we get 0.159 or 15.9%. So write that number on the side because that is the regular use space. Okay. Now, if you only have regular use space and no exclusive use, you're done. You take that percentage and you can use that to apply to every home improvement that handles that applies to the whole home. Any cost like utilities or some of your mortgage payments, whatever it is, or if you're renting, your rent, right? So, but if you do have exclusive use space, you have a couple more steps. So step 6, you divide the exclusive use space in this scenario by the square footage of the home and add it to the result from step 5. So we know here that 500 square feet are used exclusively for childcare. The total home is 1,500 square feet. So 500 divided by 1,500 equals 0.333. So we'll add that 0.333, which is 33%, right? So we'll add the 33% to the 15.9%, and we should get 49.2%. So what ends up happening there is 49.2% in this case is the time space calculation for all of those expenses that are for that are in the regular use category. Okay. We'll go through that in a minute. But for all of your allowable home expenses, if you want to practice more on the time space or do it for yourself, there's an example and a worksheet available in the workbook. Now, the general rule is that any grant money received must be reported as income. However, you can deduct any valid business expenses associated with that grant money in the same tax year. So here's the basic one. The basic scenario is that if a business received $10,000 in stabilization money, which they report as revenue, and they spent it on $10,000 in expenses in that same year, it's a wash, right? Nothing changed on their taxes. Now, let's say the business got $10,000 but only had $5,000 expenses. Well, in that case, they're going to either have to spend the rest of that $5,000 or they pay taxes on that $5,000 difference. And finally, let's assume the business got paid $10,000 for an expense that happened in a year before, right? Like let's say you bought a greenhouse, for example, and it was for $10,000 and you received the following year you receive a grant for $10,000. Well, that means that when you received it is the year in which you received it is the year in which you are taxed on it. So even though that expense was in the year prior, that grant money is taxed in the year that it was received. So that provider would pay taxes on that full $10,000. Okay. So is there any way I can mitigate last year's taxes before April 15th? Like, is there any way to change my taxes, my tax liability after all the expenses are done? So, yes, possibly. There may be a chance. If you're still looking for a way to mitigate your taxes from the previous year, you have one option by contributing to a retirement plan. We're going to put a link in the chat here to help you determine if that's like what your options are. And so if you don't already have a retirement plan for your business, setting one up could provide tax advantages. Contributions made to a retirement plan on behalf of the business owner and employees are typically tax deductible. As a small business owner, you can open a SEP IRA for both you and your employee from January through April 15th. Make contributions and reduce your previous year's taxes. You'll want to discuss this option with a financial institution or a financial advisor for more information on setting up retirement accounts. If you want to find out which plan may be the best fit for your situation, you can go to the Civitas Strategies retirement tool and then answer the questions there. We don't keep any of your information, but that can help you and guide you in which one would be a good idea for you. Could be a good idea for you. Now, while you may not have options other than retirement plans to mitigate your taxes after December 31st, remember that if that you have some other actions that you can take to make the best use of those extra funds. One, you can pay down debt If your business has any debts, this could be a good opportunity to pay them down. Two, you could create a reserve fund so that you have a financial cushion, right, for when, so you don't have to make owners' contributions. Um, you can invest in business expansion and either grow your business to have more slots available for childcare, or maybe have more staff, or both. Um, you could also set time for your mid-year tax review now. A lot of business owners will do a tax check-in usually between August and October. And even though it's kind of, late in the year, it is still considered a mid-year tax review. That can be very helpful in allowing you to see where your tax liability is heading before the close of the year, when many opportunities to affect your tax liability end. Um, and you can make your review, your mid-year tax review, as in-depth or as simple as you want. You can just from seeing if you're making some money to essentially preparing your own taxes and being more strategic. Another question that comes up is, how can I get my taxes prepared? You can either do it yourself or you can pay a tax preparer. When searching for a tax preparer, some of the pros are you have a guide along the way. A con can be that it can be expensive, right? And so when looking for a tax preparer, I'll give you a couple questions on the next slide. But some pros and cons for self-preparation are they can be a bit more accurate because you know your expenses and your income better than anyone else, and it's less expensive. A con to this could be that the guide is an extra cost. So typically, when you're filing your own taxes, you'll want to purchase a guide or some sort of software to help you through that self-preparation process. So that is an extra cost, but it's usually less of a cost than having a tax preparer provide that for you. Um, Now, when looking for a tax preparer for your business, you should ask yourself the following questions. One, are they qualified? There are several types of people out there that can prepare taxes. A lot of them are people that prepare personal, like individual taxes, because not everyone is a business owner. And sometimes those people that are preparing taxes that do a majority of personal returns don't always have the business acumen or the know-how or the knowledge to do the time space calculation, or to remember to not just do the standard deduction for meals, right? So um, it's going to be very important for you to ask these questions. Do they know can they walk you through their process of a time space calculation? If they are very nice to you and walk you through the process calmly and they know exactly what you're talking about, they might be a really great fit. If they look at you like they either don't have time or they don't know, then they might not be a good fit. However, January 1st to April 15th is tax season. So if a CPA or a tax preparer is saying, "Hey, buzz off, I don't have time to see me in May," um, they're not being mean, they're just trying to survive. So be prepared for that. So maybe, consider if you are looking for a tax preparer, ask them the questions for sure. Um, Make sure that, and another great question that's not on this slide is, are they available for audit support? If you get audited by the IRS, will they be there to support the return that they help you prepare? Definitely a great question to ask. Okay. Uh, Now, I know we're at the end of our time here. Before we jump into questions, take a picture of this. This helps you with TurboTax self-preparation guides. We're not affiliated with TurboTax at all, but this is a link to the guide to help you prepare for tax season. Um, you can also use this it's the tax review and improvement app. We'll also put all of these in the chat there for you to be able to click on, right? This is the tax rubric app. You can take your Schedule C and look at last year's return if you're curious and see if there are any red flags. Maybe you or your tax preparer missed something. You can run it through this tax rubric app, and you can see where you can improve. And then lastly, we have our proactive tax planning So this can really help you prepare for taxes, and it gives you everything that you need to just prepare to get your taxes correctly and accurately filed by yourself or a preparer. Okay, so as we draw to a close, it's extremely important to reflect on the insights that you acquired about accurately reporting your revenue and the deductions for tax purposes. Remember that the most critical step is having proper documentation and really identifying a way that you can do whether you do it on your own or you have a good preparer that you've known for a long time or you're just going to meet. It's really important to take advantage of the app and the guides that we've provided, so that way you have the most accurate return. So now, what I'd like to do is I'd like to ask for you to uh, put your questions in the chat. Aaron, if there were any questions, please put them in order that they were received, or just list them here so I can answer a bunch of questions now. We have a little bit of extra time here that we're going to give to you to be able to ask questions. Um, so let's see. Aaron, do we have any questions?
No, Rob, there are no questions in the chat today.
Wow, awesome. Well, I mean, it is what it is. You're welcome to ask any questions you have. Um, so yes, we do have those links there. I can go through a couple of the questions that I've been asked before. One of them that was really helpful was, "Hey, is it a good idea to reduce my taxes by employing my kid who's 10 or 12 years old?" Absolutely. Yes, you can. You can do that. If someone wants me to explain how to do that, let me know, and I can, just put it in the chat. Yes, I want to know how to employ my kid. If I see another question here in the chat, Miss Michelle says, "Can I explain the 940 form?" So the 940 form, um, I had to look this up before. This is a form. Let me just double check and make sure. Um, is that the form that you're required to give to parents showing that you've paid or that they've paid you or that you've charged them? Let me just confirm. So let me look that up. Um, so give me 1 second. Let me confirm because I don't want to guess. Okay. Um, so when it comes to the 940 federal unemployment. Hang on 1 second. Unemployment benefits for workers who have lost their jobs. So, okay. Um, that's a good question. So it's not the one that I thought it was. The 940 form is something that, so if you have turnover in your business and you have employees, um, then if you've paid over $1,500 in wages in any calendar quarter, you must file it. Um, so actually, okay. So for example, if you have employees, the 940 is really to help you with your payroll taxes, and this is, yes, it's very important that you file these because then it shows how much you've actually paid. So if you have an employee, if you notice, they pay 7.5%, and you as an employer pay 7.5%. That amount that you're paying, that 7.5%, just proves that you are paying that other portion. Where does that come from? If you remember when I mentioned the employer, or I mean if you're self-employed, you have to pay 15% in self-employment tax, right? So that's basically um, all employees pay some sort of tax to work here in the US, right? And so the employee pays 7.5%, and the employer pays 7.5%. Well, if you're self-employed, guess what? You're paying both halves. That's where we get that 15%. So, so yes, when you are paying the FUTA, so those taxes that we're talking about, that 7.5%, that goes towards like it's not just state unemployment, right? It's not just SUI, state unemployment. Those are it's also Medicare taxes, right? Federal unemployment taxes, um, Social Security, right? Social Security insurance is paid through those FICA and FUTA taxes, right? So that's what that 15%, that 7.5% that I'm talking about. And the 940 records those. Great question. Does anyone else have any? Okay, so I see um, commonly missed write-offs as a home daycare. So great question. You'll find this actually in the app. So we have a, sorry, we have that link to the app, the tax rubric app. So, but you other write-offs that are very common are the time space, right, for family childcare. Also, yeah, so this person, Miss Rochelle, asked for home daycare. So the time space calculation, biggest one, right? And here's why. If you prepare this on your own, or if you have a tax preparer prepare this for you, there's something called the standard home office deduction, and that's $1,500. Okay. So a lot of times these providers, these tax preparers, will just do oh, you work at home, no problem, $1,500. Well, a lot of times they don't know about the time space calculation, or they don't want to do the calculation because it's too complex. It's not too complex since we just walked through it together, right? So a lot of times, like for example, if you have if you have a smaller home and your childcare providing, yeah, I mean that space that you use is a significant amount of space of your home, like in our example, 50, almost 50%, then 50% of your utilities, 50% of your like internet cost, what it costs to like I said, utilities is a big one. But your mortgage, your renter's insurance or homeowner's insurance, all of that, that is 50% of that. And so if you have a $2,000 mortgage, 50% of your mortgage is $1,000. It's deductible, right? If 50% is your, time space percentage. That's just your mortgage. Well, looking at and that's for the whole year. So if you have a $2,000 mortgage, you're paying $2,400 or $24,000. And 50% of that is basically, used for business. It's a little higher than 1,500, isn't it? So that's one of the most commonly missed write-offs. Another one is going to be food. So in some software, it says not to use the CACFP reimbursements as income and only report the net. Wrong, right? You want to make sure that you're reporting 100% of those costs, as long as they're backed by, the proper documentation that it went to actual children that you cared for, right? But anything that came in from the food program is counted as income. Okay, so you've got to show that, and so be careful because that could be a miscategorization. Let's see. What else do we have here? Federal tax form use. Yes. Yes, that's the 940. That's right, Miss Ruth. Um, okay. And yes, a recording will be sent to providers at a later date. Links to email. So let's so if I didn't get a chance, if you still have questions or if you were interested in any additional information, um, go ahead and you can scan this QR code and it'll take you to the tomcopelandblog.com. Our organization is a steward of Tom's blog. And so there are over 1,500 helpful resources there. And if you have questions, your answer is most likely there. I'll leave this up for another second. Other than that, um, we also have our YouTube channel. You can find, I think I'm on there. Myself, other members of Civitas Strategies, we've put together videos for you to be able to see them. Um, and there's even Ask the Expert videos where we'll take questions from Tom's blog and we'll answer them on a call, much like this one. So if you have anything else, please feel free to reach out via these resources. Other than that, I'm going to hand it back over to Andrea. Thank you so much for everything that you do as childcare providers. It truly is an honor and privilege to be able to speak to you tonight. And thank you for all the little sacrifices that no one else sees, that you make every single day to provide love, care, and consistency to the children that you serve every day. So thank you, thank you, thank you for what you do. Andrea?
Thank you so much, Rob. I absolutely echo those thank yous for the childcare providers that are on our call today. We really appreciate everything you do. I hope this was a helpful call for you. I know I learned so much. This was really, really informative, Rob, and we appreciate your time so much. I wanted to just refer everyone to our resource and referral website. This is Early Care and Learning Council's website, and this page of it lists out our members. If you don't already know who your childcare resource center is, you can look them up on this website. I want to encourage you to reach out to them because each childcare resource center has a business specialist that you can meet with to talk about your thoughts on this training, to talk about other ideas you have about improving your business. And so we are really, really, looking forward to meeting with you and supporting you if you'd like. So you can go there and reach out if you're interested in that. Thank you again, Civitas, and we appreciate everyone for being here. Have a good night, everyone.
Thank you.
No problem. Please fill out the survey.
Well, there's a survey. Where's the survey?
Yes. Oh, the survey will come up after I close this call.
Okay,
So
very
please
good.
fill out
Thank
the
you.
survey that comes up. Okay.
Thank you, Wendy.
Okay. I don't have a chair. No chair?